What if there was a brand new kind of digital money, a true digital dollar, coming straight from the central bank itself? It's a huge idea that governments all over the world are exploring right now. But here's the real kicker. If they actually built it, would any of us even use it? Well, a really fascinating experiment is giving us our first real glimpse into the future of our wallets. So let's dive right in. All right, here's what we've got on tap. First, we're going to break down what a digital dollar, or CBDC, actually is. Then, we'll get into the massive question mark facing policymakers and the super clever experiment they designed to answer it. We'll find out what really makes us tick when we choose how to pay, see the model's spookily accurate predictions for a CBDC, and finally, get why the tiniest details could make or break the whole thing. So, first things first, what in the world are we even talking about when we say central bank digital currency? Okay, so a CBDC is basically a new flavor of money. Now, it's not a cryptocurrency like Bitcoin, and it's also different from the money you've got in your normal bank account. The best way to think about it is like a digital version of a $20 bill, issued and backed directly by the central bank, just like the cash in your pocket. This table right here, it really clarifies the whole thing. The cash in your wallet, that's a direct IOU from the central bank. But the money in your checking account, yeah, it's digital, but it's an IOU from a private bank, like Chase or Bank of America. A CBDC kind of mashes these two together. It's digital, but it's a direct claim on the central bank, just like cash. And that makes it the safest digital money you could possibly have. Because, private banks can fail. The central bank, not so much. And that leads us straight into the big, messy problem at the heart of all this. It's one thing to dream up a new kind of money, but it's another thing entirely to figure out if anyone's going to want it. And that right there is the multi-billion-dollar question, isn't it? I mean, how do you forecast demand for something that has never, ever existed? You can't just look at past sales data. This huge blind spot is a massive hurdle for central bankers trying to make smart decisions. Just think about it for a second. If you suddenly had a new government-backed digital wallet on your phone, would you actually use it? I mean, instead of your credit card, or Venmo, or Apple Pay, or just plain old cash? The answer isn't so simple, and that's exactly what these researchers were dying to find out. So this brings us to the really cool part of the study. To crack this problem, researchers designed this brilliant experiment that was basically a giant game of would you rather for your money.
So here's how they did it. They broke down any payment system into 9 key ingredients. Stuff like fees, privacy, and discounts. Then they used those ingredients to cook up thousands of unique, imaginary payment methods. They got over 3,500 people, showed them pairs of these options, and just asked, which one do you prefer? And by making each person do this 5 times, they could use the data to figure out what we really care about when we pay.
And this is a perfect example of what people saw. So what would you pick? Payment method A, a smartphone app straight from the central bank, gives you a 3% discount, but checkout takes 2 minutes. Or method B, a plastic card from a private bank. You can use it everywhere, it's super fast, but it has a monthly fee. See? There's no obvious right answer. You have to make a trade-off, and that's exactly what reveals your hidden preferences.
And these are the 9 dimensions they were playing with. And you can see just how thorough this is. It covers the whole shebang, from who's behind the money and how much privacy you get, to the really practical stuff like, do you get rewards or do you have to pay a fee every month? By mixing and matching all of these, they could isolate the exact importance of each one.
All right, so after thousands and thousands of these choices, what did the data actually show? What do we care about most when we pull out our wallet or our phone?
Well, this single biggest finding is probably not going to shock you. It turns out money talks. As the study's authors put it, our choices are highly sensitive to financial incentives. And let's put a hard number on that. Just adding a tiny monthly fee, about $3.50, made people a whopping 14 percentage points less likely to choose that option. The message is crystal clear. We really, really hate fees. And on the flip side of that coin, we absolutely love rewards. Offering a 5% discount or cashback made a payment method 11 percentage points more appealing. This one number basically explains the entire credit card rewards industry. The carrot is almost as strong as the stick. But hey, it's not all about the money. A few other things really matter to us too. We have a huge preference for digital forms, apps and cards over old school cash. We want to be able to use it everywhere, no questions asked. And of course, it has to be secure. Oh, and here's a fun one. All things being equal, we do have a slight but real preference for something issued by the central bank.
Okay, so this is where it gets really cool. The experiment told us what we value, but the real test was whether they could use that knowledge to predict the future. And before they could do that, they had to prove their model could accurately predict the present. And check this out. This part is brilliant. Before they even touched the CBDC question, they used their model to predict how people use existing payment methods in South Korea. And look at this. Their predictions were incredibly close to reality. They predicted card usage at 61%. The real-world number is about 70%. This proves their model isn't just a fun academic exercise. It actually reflects how people behave. So the model works. It's solid. Now for the moment of truth. Let's drop a basic central bank digital currency into this simulated market and see what happens. And here it is, the headline result. If a simple, no-frills CBDC was introduced, it wouldn't kill credit and debit cards. They'd still be the king of the hill. But look what happens in second place. The CBDC would capture a huge chunk of the market, jumping right over popular mobile payment apps. Yeah, that number is 19%. Think about that for a second. The model says almost 1 in 5 people would choose a brand new basic digital dollar as their go-to payment method. For a completely new form of money, that is a massive potential adoption rate. It suggests there's a real untapped hunger for a public digital payment option. And this brings us to the final and maybe the most important takeaway from all this research. If a CBDC is ever going to happen, the design choices, they are absolutely critical. I mean, this slide says it all. Remember how we are suckers for financial perks? The researchers ran another simulation. They asked, okay, what if the CBDC wasn't so basic? What if it offered a 5% discount, just like a good rewards credit card? Well, look what happens. The predicted adoption skyrockets from 19% all the way to 27%. That one tiny design choice could boost its popularity by nearly 45%. That's huge. So what this incredible research really does is it takes this huge abstract idea and makes it real with actual data. It shows there's a genuine appetite for a public digital currency, but its success or failure is going to live or die on the details, getting that balance right between security, privacy, and, yep, incentives. So it leaves us with one last question to chew on. What would it take for you? What's the one killer feature that would make a digital dollar your #1 way to pay?